In the heart of Manhattan, the New York Stock Exchange, or NYSE, stood as a symbol of America's financial might during the 1970s. Recognized as the world's largest stock exchange, the NYSE played a pivotal role in shaping the economic direction of the country. It was a time marked by significant change, both on Wall Street and beyond. The decade was characterized by economic uncertainties, including rising inflation and unemployment, which culminated in the oil crisis of 1973. This crisis not only placed a strain on the economy, but also forced a national dialogue about energy resources and consumption habits. As the 1970s progressed, a growing awareness of environmental issues began to take root in the United States. Events such as the first Earth Day in 1970 brought environmental concerns to the forefront of public consciousness, prompting citizens and organizations to advocate for more sustainable practices. This newfound activism led to the establishment of organizations like the Environmental Defense Fund, which pushed for stronger environmental regulations and greater corporate accountability. The result was a societal climate ripe for change, and the NYSE was not immune to these shifting tides. In response to this rising environmental consciousness, the NYSE began to explore its role in promoting corporate social responsibility. The exchange initiated discussions about how financial markets could support businesses that prioritized environmental stewardship alongside profitability. In 1971, the New York Stock Exchange even introduced its own listing requirements that encouraged companies to disclose information about their environmental practices. This move signaled a departure from traditional profit-driven motives, suggesting that the NYSE recognized an emerging responsibility to consider the environmental impacts of its listed companies. The influence of institutional investors also played a critical role in this shift. By the mid-1970s, a growing number of investment firms started to prioritize environmental and social governance (ESG) criteria as part of their investment strategies. This change urged companies to rethink their operations and consider the broader effects of their business decisions on the environment. The NYSE, responding to this trend, began to see the synergy between economic growth and environmental sustainability as a way to attract capital in an increasingly conscious market. Despite these promising developments, the NYSE's flirtation with environmental initiatives faced considerable challenges. Economic pressures intensified in the late 1970s as inflation soared and oil prices fluctuated dramatically. The financial community began to prioritize short-term gains over long-term sustainability, leading many corporations to sideline their environmental commitments in favor of immediate profit. The stock market's volatility diminished the focus on corporate responsibility, and many investors became less inclined to champion the environmental initiatives that had gained traction earlier in the decade. As the decade came to a close, the initial momentum for environmental responsibility within the NYSE waned. The combination of pressing economic realities, coupled with a return to traditional profit maximization strategies, overshadowed the earlier aspirations for reform. Though the 1970s marked a significant moment in the relationship between Wall Street and environmental issues, the subsequent neglect of these initiatives would set a precedent for the challenges that persist in blending economic and environmental priorities today. In examining the rise and eventual fall of the NYSE's environmental initiatives, we gain valuable insights into the complex interplay between financial motivations and climate change action. This historical perspective serves as a crucial backdrop for understanding the ongoing conversations around corporate responsibility and environmental sustainability that continue to unfold in today's financial landscape. In 1971, the New York Stock Exchange established the Environmental Action Committee, marking a significant step toward integrating environmental considerations into financial practices. The committee's primary goal was to assess environmental criteria related to trading, thereby fostering a new awareness among investors and financial institutions. This initiative reflected a growing recognition that the financial sector had a role to play in addressing environmental challenges. As environmental consciousness gained traction, the NYSE began to cater to investors eager for sustainable investment opportunities. In response to increasing demand, the exchange introduced a variety of environmentally focused investment vehicles, including green bonds and socially responsible funds. These financial instruments offered investors the chance to support projects aimed at environmental sustainability while potentially achieving competitive returns. This innovation indicated a burgeoning recognition that profitability and environmental responsibility were not mutually exclusive, but could coalesce to create value. Moreover, the NYSE made strides to promote corporate social responsibility (CSR) among its listed companies. Through various initiatives, the exchange encouraged firms to implement environmentally friendly practices and to report on their environmental impact. The NYSE suggested that corporations adopt policies addressing pollution and resource management, aiming to create a culture of accountability within the corporate sector. Notably, this push came amidst a broader cultural shift where environmental advocacy began to permeate various sectors of society, propelled by events such as the first Earth Day in 1970. Despite these promising initiatives, the economic landscape began to shift dramatically later in the decade. The oil crisis of 1973, coupled with persistent inflation and economic stagnation, created a climate where financial pressures increasingly dominated corporate decision-making. As profits became a priority, many companies found it challenging to maintain their commitments to environmental initiatives, resulting in a retreat from earlier environmental goals. The urgency of immediate financial needs often overshadowed the long-term benefits associated with sustainable practices. By the late 1970s, the commitment to environmental responsibility from Wall Street, particularly through the lens of the New York Stock Exchange, began to wane. Many initiatives that had once seemed promising were sidelined as companies grappled with falling profits and increasing costs. This shift illustrated a profound tension between environmental imperatives and the relentless pursuit of profit that characterizes the financial industry. The embrace of sustainability, once gaining momentum, was soon forgotten as economic pressures took precedence. Furthermore, as the NYSE's environmental initiatives faltered, the broader investment landscape revealed patterns that would echo into the future. Institutional investors who initially sought to support environmentally sound practices began to prioritize short-term gains over long-term sustainability commitments. This trend, rooted in 1970s economic challenges, contributed to a legacy of environmental neglect in corporate America that would prove difficult to unravel in subsequent decades. In conclusion, The New York Stock Exchange's environmental initiatives of the 1970s represent a fascinating case study of ambition meeting reality. The promise of integrating environmental responsibility into financial practices shone brightly for a brief moment before being dimmed by the harsh realities of economic survival. This historical context not only sheds light on the early tensions between financial motivations and environmental stewardship, but also serves as a reminder of the ongoing challenges we face today in aligning economic systems with climate action. As the 1970s progressed, the economic landscape shifted dramatically. The 1973 oil embargo precipitated a global energy crisis, leading to skyrocketing fuel prices and widespread inflation. In this climate, the New York Stock Exchange found itself grappling with significant economic pressures. The urgency of the energy crisis overshadowed environmental initiatives as both investors and corporations recalibrated their priorities toward immediate financial survival rather than long-term sustainability. This profound shift marked a turning point in the NYSE's environmental journey, a reality that would soon put their earlier initiatives under scrutiny. Critics emerged from within the investment community, where the hierarchy of priorities increasingly favored short-term profits. Many traders and investors viewed environmental responsibility as a luxury that could only be afforded in stable economic conditions. They communicated a clear message. In an era marked by economic uncertainty, the focus needed to be on returns. The introduction of socially responsible investments and green bonds, once viewed as promising opportunities, faced mounting skepticism. Investors questioned their viability amidst a struggling economy, leading to calls for a reallocation of limited resources. This evolving perspective presented significant challenges for the NYSE's Environmental Action Committee. Initiatives launched with enthusiasm were now scrutinized under the harsh reality of quarterly earnings, as companies across various sectors scrambled to adjust their strategies in response to the recession. The commitment to sustainability became increasingly diluted. Reports indicated that investment in environmental projects was halved as market downturns loomed large, revealing a lack of resolve in the face of immediate financial pressures. The NYSE also faced external criticism and resistance from traditional investment analysts and financial firms, who expressed doubt over the profitability of sustainability-focused initiatives. Many analysts argued that environmental issues should not prioritize the financial considerations that underpinned successful trading. As corporate social responsibility became secondary to the need for liquidity and immediate returns, the NYSE's capacity to advocate for environmental initiatives began to wane. By the late 1970s, the withdrawal of key environmental initiatives became evident. The NYSE had, at one point, made significant strides in incorporating sustainable practices. However, as earnings warnings piled up and fears of recession took hold, the commitment to those ambitious environmental projects soon receded. The pressure to align with market trends and investor expectations took precedence over initiatives that required a longer-term commitment and investment. This cycle of growth and retrenchment spoke volumes about the prevailing attitudes toward capitalism and environmental responsibility. The short-lived enthusiasm for sustainability within the NYSE became a microcosm of the broader conflicts faced by many industries during this time. The increasing divergence between the imperatives of financial markets and environmental stewardship highlighted a tension that remains relevant today. In retrospect, the NYSE's experience in the 1970s serves as a powerful lesson about the fragility of environmental commitments in economic downturns. A combination of rising costs, investor impatience, and corporate recalibration led to a diminished commitment to sustainability, reinforcing the notion that financial incentives often dictate the pace of environmental progress. It's a pattern that continues to resonate in the ongoing conversations about climate resilience and corporate responsibility in today's economy. The legacy of the New York Stock Exchange's brief engagement with environmental responsibility in the 1970s offers critical insights into the complex dynamics between financial imperatives and environmental advocacy. While the initiatives of this era were initially framed within a context of corporate social responsibility, they also underscored the prevailing belief that sustainable practices could coexist with profit maximization. However, this belief would soon clash with harsh economic realities, illuminating the fragility of such commitments in times of financial distress. The economic backdrop of the late 1970s, characterized by stagflation and rising unemployment, shifted focus away from long-term environmental goals to more immediate concerns of fiscal survival. The energy crisis, which had begun in 1973, prompted a reevaluation of energy-focused investments. The failure to consistently prioritize ecological considerations revealed a significant tension within institutions, with many in the investment community prioritizing short-term gains over the potential long-term benefits of sustainability. As financial pressures mounted, the NYSE saw a decline in its enthusiasm for sustainability. The shift in focus can be traced to a broader skepticism surrounding socially responsible investments. Investment strategies increasingly favored quick returns, and resources once allocated to environmental initiatives were redirected towards meeting more immediate financial demands. This decision reflected a critical moment in the history of corporate America, one where the demands of shareholders for immediate returns often prevailed over the aspirations of environmental advocates seeking a more sustainable future. The decline of the NYSE's environmental initiatives during this period foreshadowed ongoing struggles in the decades that followed. Throughout the 1980s and 1990s, the tensions between financial motivations and environmental stewardship persisted, as corporate accountability to shareholders took precedence. Notable events in the years that followed, such as the rise of the green investment movement in the late 1990s and early 2000s, evidenced a renewed interest in environmental considerations. However, these movements were often at odds with the short-term profit frame prevalent in traditional investment strategies. The NYSE's fleeting embrace of environmental responsibility serves as a case study for the broader challenges financial institutions face in addressing climate change today. While the importance of corporate responsibility and sustainability is widely recognized now, the underlying conflict between profit motives and environmental commitments remains a hurdle for many. Financial institutions continue to grapple with the implications of integrating sustainable practices into their core operations, balancing the need for immediate returns with long-term ecological considerations. Furthermore, this historical context sheds light on how economic systems can hinder or enhance climate action. The lessons learned from this period serve not only as a reflection of the past, but also as a cautionary tale for the future of financial markets in the context of environmental crises. As society increasingly confronts the realities of climate change, understanding the interplay between financial motivations and environmental advocacy becomes crucial in crafting effective strategies for sustainable development. In conclusion, the rise and fall of the New York Stock Exchange's environmental initiatives in the 1970s highlights a nuanced reality: that while the aspirations for sustainability existed, they were often overshadowed by immediate economic pressures. This relationship between financial volatility and environmental accountability remains central to the discourse on climate action today, underscoring the ongoing need for a balance between economic sustainability and environmental stewardship.